to see the obvious that weaponization of the Treasury and of the dollar and the SWIFT and mismanagement of our fiscal responsibilities to the world and maintaining value of our dollar and of our Treasury. These things have all been classic in terms of why the hell would anyone want to hold our Treasuries and or sell us their goods for a depreciating asset like this. So yeah, I think we've seen a push towards many central banks favoring gold instead of U.S. Treasuries, slowly, not to cut off their nose to spite their face, but it is a growing trend that we've talked about forever in the BRICS nations, and it's expanding. And quite frankly, I think it's silly to look. The reporting holders of the CME group, which are the big banks, and even the government, who is listed on the CME website as we do trade for national governments or for central banks, they trade for, and now that metal has been classified national security priority. These things, I guess, shouldn't be that hard to imagine if it is in the sake of or in the name of preserving the integrity of not only the exchange, but some of the very, very big players who have been trying to get out of these positions, arguably. We're 4 days before the February contract has to deliver. Has to. 3 days now. As of yesterday, 4,366 contracts are still open. This late in the delivery cycle, everyone's focusing on March, which comes off the board also on Friday. But to see February still open is 24 times normal right now to have this kind of volume, 13.5 tons that is still open. It's insanely high for this late in the cycle, even bigger than the March contract before they just knocked all of the open interest out of it. So in other words, you have someone who is short and hasn't closed out for weeks. And if they were planning on buying it back, it appears that they were trapped. But the point of it is that how do you have, with 2 days left to deliver this much in open interest in gold and silver still standing for delivery? It's a massive red flag. And I think, again, this is a market that works on confidence. And the moment the market believes there isn't enough metal, this leverage unwinds, and in commodities unwinds violently. That's what they tried to stop, in my opinion. When you see vault withdrawals, 164% of the February delivery demand, again, this is telling you that players would rather pull that out, deal with the logistics, the security, the insurance themselves, because they don't trust leaving it within the COMEX eligible category. This is insane. And if we look at the March 2026 open interest 2 days ago, it was almost 48,000 contracts representing 240 million ounces. They just knocked the hell out of it and got it on sides. And again, but at what cost? They got it down to just under 10 million open interest, that there is enough silver to be delivered, but at what cost? When you see the market close after starting to move up, close or shut down because of some fault, and then open up and get clobbered right then and there, it just becomes so obvious. If it were me and I had this kind of exposure to the market, I would stand for delivery and I would pull it the hell out of the exchange as fast as I possibly could, because it's telling you by their actions, regardless of who said to do it and who was behind it, it's telling you by their very actions, it's a system that cannot be bought every time it drops below 70. It seems to get sold every time it touches 90. Yesterday was a good example. Bust through it and bang, they hit it. And that's something that we've seen throughout all of the years. There are these ceilings and these floors, and they try to get, they try to get through it, they get knocked down, they fall below it, and they come back up. Where does it ultimately go? I guess we'll see. But for the foreseeable future, I think $90 is a safe bet as to how high it will go without running into this kind of overt resistance. But that's just building steam and trading in a range before it makes its next violent leg upward, based on supply running into a very big problem with more demand than there is supply.
Well, that's
of that. There's always been the overhanging threat in any mining endeavor of geopolitical risk. This takes it to a whole new level, and I think it would have a profound impact, 100%, at least until things get under control.
How quickly, what would the timeline be for this supply issue to start being seen in the prices, do you think?
You would think it would be immediately. If indeed they have if this massively disrupts the supply chains in Mexico. You hear that rumor of Samsung flew to Mexico to open up a mine for all of their doré and concentrate in order to, facilitate their battery operations. What does it do to a company like that? Do they rethink their problem? Are they some of the ones that are pulling the metal off of the exchange because of what they saw? This is a situation where it becomes even more imperative for the U.S. to do things like classify silver as critical because supply chains are being disrupted. And not only that, the exchanges by which these commodities are freely traded seem to be less than sincere. And when you realize we're now in the 6th year of a supply-demand imbalance into the billions of ounces cumulatively, 200-300 million ounces a year, this becomes a real problem when you are putting a big question mark in front of the very largest producing thing. And again, I'm not an expert on what has transpired over the last 50 years in Venezuela, but when you have the Western oil companies built the infrastructure and had a deal in place until Maduro took over, you have a leg to stand on. When you talk about going into a country like Mexico because of the cartel and using it as an excuse to take over their silver mines or their silver production, it seems like a stretch.
It does seem like a stretch, especially
security, and that raises the cost. It's going to hurt probably the bottom line on their share price. All of these things come into play, but I would have a very hard time believing that this administration would go in under the guise of eradicating this terrorist group that they have now named the cartel terrorists and use it as a stepping stone to nationalize or take over there for the last 15, 16 months is partially the U.S. government under the umbrella of the Exchange Stabilization Fund, where they, if it's national security, do not need to get congressional approval and do not need to speak about it. And again, who is pulling 38 million ounces out? Where's it going? To your point, could it be Samsung and Sony and Tesla? Sure, it could. But could it be the national government or the Treasury Department? Absolutely, it could. Well, and this is an orderly drawdown of open interest, like it always does. How can anyone call what we just saw orderly? It's not orderly. It is anything. It's far from orderly. It's chaotic, and it's overt. And yes, the CME Group always finds a way to draw down open interest into the delivery month so that it does not exceed what can be delivered. Once again, they did it, but at what cost? And anyone who would claim that this is orderly, I disagree with. This is flippant. This is right in your face, and what are you going to do about it kind of thing. And that's, to me, why you see lots of metal now leaving. In fact, way more than the February deliveries can explain. So I don't know. I think that right there was very, very telling on just how plausible it would be that the gold and silver that we've seen come in since a year ago, November, in massive amounts that is being delivered to COMEX. Some doesn't leave, a lot doesn't leave, but now we see some leaving and maybe a lot leaving. So that to me would easily be one price floor to incentivize domestic mining, a stockpile to protect national security, right, refining and smelting to be able to produce it yourself. It's all pointing to gold and silver being far more important than the dollars that they're valued by are telling us.
Right, and that of course ties.
So yeah, the cost, I don't know what the all-in sustaining cost would be, but I have to venture it's much, much higher than what we see right now, or that stuff would have been mined already. So yes, would be to incentivize the domestic industry of issue with AI and robotics is what it does to the economy and to people's standard of living's massive efficiency at the expense of millions of jobs. There's another example of how AI and robotics will completely upset the apple cart even in the mining industry. I don't think that it is simple as having a robot dig 24/7 for gold and silver. It's not that simple, but sure, it might add a little bit. But like to the silver point, we've had a 200+ million ounce shortfall between supply and demand for now going on 6 years. So that robot should start digging right now to help just get to where we need them to be in terms of supply demand.
Plus that robot is going to
very difficult places to do so that robotics may come in handy, but I don't think it's as easy as he's painting the picture to be. Interesting the way he frames it. something to think about, but I wouldn't be concerned that this all of a sudden would just unlock massive amounts of supply hidden away in difficult places to reach.
And again, you need
Overweight. And billionaires like this and Ray Dalio, and who are all framing gold and silver as integral to portfolios, to see the obvious that weaponization of the Treasury and of the dollar and the SWIFT and mismanagement of our fiscal responsibilities to the world and maintaining value of our dollar and of our Treasury. These things have all been classic in terms of why the hell would anyone want to hold our Treasuries and or sell us their goods for a depreciating asset like this. So yeah, I think we've seen a push towards many central banks favoring gold instead of U.S. Treasuries, slowly, not to cut off their nose to spite their face, but it is a growing trend that we've talked about forever in the BRICS nations, and it's expanding. And quite frankly, I think it's silly to look. The reporting requirements by the governments to the IMF as to how much gold they're bringing in is voluntary. I would think that many of the central banks, even those that claim to be our allies, are doing the same thing, realizing the fragility of this system that is not only well past its prime in terms of its age, but what we are doing fiscally, our monetary choices, and then the weaponization and the sanctions that are pretending to be tariffs are wearing thin on much of the global wealth. And why hold treasuries when you can hold gold, which has massively outperformed the treasury market for 25 years, but has no counterparty risk? And that's what it boils down to, lack of trust. And the production, the refining, the stockpiling, this is big for the entire industry. And maybe it's finally an admission by these people that this is an important part of any portfolio. And even at the highest level, they're telling their clients, hey, you got plenty of room left in growth on gold and silver, and you should own some. Has run into some severe problems with liquidity due to the increase in margin requirements on COMEX, which has spilled down into this industry and log jammed everything, gummed it up. And I think if I had to guess, they won't do that again. If I had to guess, they got some severe flack about what this did to the economy. These refiners don't just handle gold and silver. They have integral parts in the economy, and the refiners have been margin called across the board and shut down because the price had been going up so fast, along with the increase in margin, that it became impractical and too expensive to continue refining metal or paying for it and refining it when it takes so long to produce it. It gummed everything up. It gummed everything up all the way from the depositories, the IRA custodians, the logistics. It's something I've never seen before. But I will tell you that this all coincided with massively increasing demand through January. As strong of demand as I've ever seen in my career. We did as much business in the month of January as we did in a third of all of last year, which is one of our biggest years. And then, much like the speculation that it increased on COMEX, what they did to bring down this open interest was to massively increase the cost of owning that leverage. And the unintended consequence was this industry that is experiencing some significant liquidity issues that seem to be starting to unwind. But I know that's not what you asked. The moral of the story is that this tremendous volume that we saw on COMEX, or demand that had pushed the prices higher too, we've also seen in the retail industry that we haven't seen for quite some time in terms of concentrated demand, where January was as crazy as anything I've ever seen. I would think that's emblematic of people waking up. Now, the effect of smashing it to these people, knocking it down, I think knocked the wind out of a lot of people who are like, wow, how can that happen? It's a temporary setback, and here we are climbing right back up again. I think that we will see very, very, very strong demand into an industry that has experienced difficult supply acquisition because of all of these fundamentals. So it's been a very stressful couple of months with massive demand and supply and liquidity problems throughout the entire ecosystem, I guess is the best way I can explain.